the technology companies that we're investing in, we want them to have a direct impact on the bottom line of their customers. So there are, companies out there that might help with productivity or other areas that do impact the bottom line, but not as directly. Versus we're looking for things that are, immediately helping them make more revenues or cut down on costs.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Alex Ferber with us. Alex is a general partner at Green Egg Ventures, where they're investing in early stage B2B SaaS companies. So in this episode, we talk about how Green Egg Ventures got started, what they look for in companies, perspective on exits, exciting portfolio companies, and a lot more. So without wasting any time, let's dive straight in. Hey Alex, so good to have you on the VC10X podcast. How are you doing?
Hey Prashant, I'm doing really well. Thanks for having me.
Yeah, pleasure hosting you. So to start things off, I would like to understand the story and your background, like how you started Green Egg Ventures.
For sure. So I'm originally from Michigan, and I initially moved to New York, and my plan was to get some startup experience. So my goal was to work at a startup, wear a bunch of different hats, and get that experience before moving back to Michigan. However, I got really lucky. I got an interview to a venture fund to come on as an intern. I got interviewed as a venture fund to work at one of their portfolio companies. And rather than put me at a portfolio company, they ended up bringing me on as an intern. And then after a couple months, I ended up getting a full-time position. That fund was called Metamorphic Ventures back at the time. And I immediately fell in love with venture, just meeting people that are taking risks and going out to solve problems in the world, helping those companies grow. I knew I wanted to do venture capital forever. So after a few years of working at Metamorphic, I figured it was a good time to go out on my own, take that leap. And we did. We ended up launching our first fund back in 2016. Now our second fund in 2020, and are raising a third fund now.
Yeah, that sounds incredible. So it seems like you are one of those people who started their careers directly in venture capital. We have a lot of folks who start out in different careers and then switch over and get into venture capital. So can you tell me, how was it? How was the experience of getting into venture capital straight away? And then how did you learn the ropes? Like what were the initial things that you started to learn? And over time, how did you build this understanding of different businesses to be able to now have your own fund, which is now itself 6-year-old fund, and now you're raising a third fund, right? So can you tell us about that entire journey from start, from the very basics, from where you started to now you're actually leading a fund?
Yeah, so I never thought I would get into venture capital. I'd grown up working for my family business, and which involved traveling to China a lot, finding products that were being manufactured overseas and then selling them. So in the US, so it was, I got really, really lucky getting into my first venture job. And, like I mentioned, just basically, learning about all these new great technologies out there, learning about problems in the world from people who've lived them, and then, seeing all the innovative solutions that people come up with was just an absolute treat. So, so to answer your question, we basically founded the fund in, we started fundraising in 2015, raised the fund in 2016, and then started investing out of it. The first fund was a smaller fund, more of like a proof of concept to show that we knew we were doing. In terms of how I learned the ropes in growing, I was really lucky at Metamorphic. I had some really great bosses over there, and people I worked alongside of. So at first it was really just sitting in meetings, listening to the questions that the partners were asking or associates, and really just ingraining myself in the processes of the fund. So doing things like managing the deal flow, seeing all the companies that were coming through, understanding why there were certain deals that we were passing on, deals that we were investing in. Assisting with the due diligence was obviously really, really helpful too. And just being a part of seeing companies go from initial outreach to us investing in them. And then one thing that we did also, which I really loved, was the portfolio support after we invested. So, there would be times where I'd go for a week, and work with a specific company for like a week that was just growing, and maybe there was a specific project that we were helping them out with. So being on that operator side as well was really helpful. And then as we launched our first fund, definitely made a lot of mistakes. As we've been growing, and learned from them, and then basically have been just applying those learnings for our second fund and our third fund. So the whole thing's is just a constant learning experience in venture.
Right, absolutely. And one thing I wanted to ask you is that why? What's the thought behind the name Green Egg Ventures? What does it mean?
Yeah, it's a good question. We were initially support capital just because it's kind of straight to the point, but didn't really love that name. So we ended up coming up with Green Egg Ventures because we were thinking of we help companies get going. So we were thinking of sort of like breakfast themed, and we came up with double shot ventures and cold brew ventures. But people, rather than double shot espresso, people were like double shot tequila, and then rather than cold brew like coffee, people associated with beer. So we ended up landing on Green Egg. Green is signifies growth and money. Egg, sort of like seed, where we do seed investing. And then Green Eggs and Hams, a memorable Dr. Seuss book. So we figure the name Green Egg Ventures is memorable for that reason as well.
Right. Yeah, love it. Now, coming on to the investment thesis. So what's been your thesis? When you started out investing, how has the thesis evolved over time, that as well?
Yeah, so we've always been a fund that focuses on business to business. So we avoid consumer, we avoid hardware, and anything deep biotech. And the thesis has changed a little bit. When we first started back in 2016, we basically were investing at a $5 million valuation or less. We are very early. Obviously, that price has sort of changed these days, especially last year or a few months ago. We've sort of upped that to a $10 million or lower valuation, which is still, compared to our peers, a very, very low valuation to be coming in at. And so we like to say that we are, we're wide on industry. So we invest widely across business to business in a bunch of different verticals, but we're much more narrow on the stage. So we're investing at a $10 million valuation or less, and at the post product market fit stage, typically when the company has traction with revenue. So finding companies that have both traction and at a 10 million or lower valuation is definitely more and more rare these days. But we're definitely able to find those businesses in maybe more niche industries, solving more niche problems, but they still have a ton of potential. So yeah, that's sort of how we see ourselves in terms of our focus.
Right. And since these companies are like so early in the process of their startup journey, and you want to make investments in them, so what is the criteria of making the decision that whether you want to make an investment or not? How are you evaluating these companies, since there is not a lot of data to see at that point of time? So what do you look at?
So there's a few things that we look at. Firstly is, who is the founder? Why are they the right person to be solving the problem that they're solving? What insights do they have? Connections in the industry, and just really understanding, the why they're founding the company. Running a company is difficult, and if you're in it for the wrong reasons, when things get difficult, it's easy to bow out. Versus someone who's more mission driven and solving a problem is going to be is going to deal with the blows a little bit better. So we're looking at the founders. Was the founder able to attract maybe an engineer as a co-founder, CTO, or maybe the CTO is one of the co-founders? But being able to attract other people to your idea is also really important. Shows that you can communicate what you're solving, and your ability to, attract talent goes a long way. So that's number one. Number two, we see a ton of companies every week, and we see a lot of the same sort of things. So when we see something that's really new and original, it gets more exciting. So we're trying to, identify those deals where they really are differentiated. And, that's something when we're going through our deal flow, when we're going through, 50 or 60 companies at a time, we're quickly able to knock out the ones that look, more broad, not as focused. Um, yeah. So, those are two big things. The other things that you're asking are, of course, if they do get it right, what's the potential of this business, is another big thing. And then lastly, before investing in any company, we typically do about 4 to 8 customer calls or reference calls. So we'll talk to customers, hear what their life was like before they used the technology and what their life was like after. And if we have 6 calls with customers and they won't stop talking about it, they're not waiting for me to ask questions, they're clearly excited about it, those are the things that we're investing in. Versus if someone sounds more bored with it, or those are the ones where maybe it's not as much of a need to have, it's more of a nice to have. So yeah, and then the technology companies that we're investing in, we want them to have a direct impact on the bottom line of their customers. So there are companies out there that might help with productivity or other areas that do impact the bottom line, but not as directly. Versus we're looking for things that are immediately helping them make more revenues or cut down on costs.
Right. Right. That makes sense. Yeah, those are like good criteria to evaluate an early stage company. Now, moving on to the deal flow. Like you mentioned deal flow quite a few times in a conversation up until now. So, what are the major sources of your deal flow, and how do you get that targeted deal flow of those early founders, or still early in their journey, to come and pitch you?
Yeah, it's a good question. So there's a few ways that we go about deal flow. Firstly, we have a really great community here in New York City. So just being out there, going to events, networking with other venture funds. A big thing that we do is we just share deal flow with colleagues, and so that's really a big piece of it. So yeah, sharing deal flow with colleagues. A big thing that we do is we're very hands-on with our portfolio companies. So we never invest in a company without first telling them you could talk to any of our other investments and hear the work that we do. And we'll probably get into that a little bit later. But by adding value to our companies, it basically means that other funds like to have us in the round. It often means too that even if a round is oversubscribed, we can still convince the founder that we're worth being a part of the round. So that's a big source of it, is just being known for that value add. There's other things too where there's obviously a lot of great incubators and accelerators out there that we stay up to date with, a lot that we're close with, and we'll meet with companies throughout a program. There's a lot of cold outreach to us just because we're on probably some lists out there in the internet. So yeah, it's a lot of deal flow, and but I think what it comes down to really is just being a good member of the New York City community, sharing deals with people and getting deals back.
Right, absolutely. And talking about the very recent developments, and since you're mostly investing in software companies, so there is this exciting thing that's everyone is talking about. It's the GPT and AI, and I would like to know what's your perspective on that from an investor's view. Are you pretty excited about it? You're going to invest some money into that space, or do you still want to wait and see how that evolves over time?
What was the space you mentioned before AI?
I just said GPT, which is OpenAI thing. So basically, broadly speaking, the AI space in itself.
Yeah. So the AI space it's different. It's not like fintech or healthcare. It sort of goes across all industries, right? It's so AI is definitely obviously a space that I think every fund looks at. It's, AI is tricky because a lot of people, talk about AI or claim AI, and there's different levels of sophistication. So, I think the question to understand is what is the AI like helping the company enable? Is it making the software smarter? It's so yeah. It's I guess that's what we try to understand is what the AI is enabling. It is a space that we invest in. Like I said, will continue to shape industries, in ways that we don't understand. So it's important for us to be at the forefront of that.
Right, absolutely. And talking about your portfolio companies, so would you like to mention some of your portfolio companies that are doing exciting work in different areas?
Yeah. It's tough to choose. So we have 51 investments between our two funds.
Right.
I guess I can mention one from each of our funds. So in our first fund, we have a really cool company called Near Space Labs. Basically, the way that the company works is they put a balloon up in the stratosphere with a camera on it, and they look down over an area of interest in high res and collect data on it. So the satellite imagery is a huge space right now, just sort of seeing, from above. And the problem with satellites is that you only get a picture every so often, right? You can't stop a satellite in mid orbit versus a balloon up in the stratosphere. You can keep up there for a long period of time. And there's a lot of really interesting information that you can pull, whether it's real estate data, insurance data, seeing if there's any, after a disaster, what the total damage is, being able to, see data on global warming or other areas like that. So I just think that's really cool. And what's really cool about that company is they're trying to democratize that data for anyone. So anyone can go in, plug into to their platform and start utilizing them. They're a really cool one. In our second fund, in between two, let's go with Native Voice. They're a really cool company. So with Native Voice, the idea is that in the future, our devices won't distract from the real world. So right now, if you and I are having a conversation and I pull out my phone and start looking at it, it takes away from my attention on this conversation. So if I'm trying to interact with a brand or pull up information on anything, my attention is shifted to my device. So in the future, the idea is that voice will be a big part of it, and I'll be able to interact with brands, devices, all through voice, pull up information when I need it. And Native Voice is helping to enable that. So Native Voice is essentially the bridge between anywhere that there's a microphone, whether it's in your headphones, in your car, in your speakers, and a brand's voice services. So if I want to speak to Starbucks and have them have a latte waiting for me at 8 in the morning, if I want to order an Uber XL, pretty much interact with any brand in any kind of way, I would do that through Native Voice. So rather than the brand needing to connect to Skullcandy, Bose, Sennheiser, they just connect with Native Voice, and from there it'll connect with all the brands. So I think that they're a really exciting company that's a part of the future of voice.
Right, absolutely. I'll make sure to put the links to both those companies in the blog post. I'll go along with this episode so that our listeners can check that out. And now, can we talk about exits? Are you thinking about exits when you are starting out making an investment and evaluating a pitch that, okay, is there a big exit potential in this or not? And the other thing is about, I think you have had some exits as well in your portfolio. So can you talk about how those played out, to give us a few examples?
Yeah. So, as a fund, one of the main reasons why we're investing at such, why we're so focused on low valuations is just because, exits happen much less often in the billions than in the hundreds of millions. And for us, we want to be able to, hit home runs for those exits that are in the hundreds of millions. And get a good multiple. So when we're thinking of exits, it's, we're less of a fund that is, looking for those unicorns or decacorns, and more really trying to find those that have nailed the product market fit, maybe in a more niche industry which still has a ton of potential to be huge, but maybe not at the same scale as where other funds might be focusing. So that's how we think about exits. We don't go into diligence being like, we're only going to invest in this company if there's like these ways it can be acquired or go public. We're just focused on the company building a great business, defensible business, and then from there, let the rest sort of take care of itself. We have had some exits, some big, some small, and I guess as a story, one of our most interesting exits was just a company. They were called Message.yes, and they had a cool technology. They were basically just like allowing any influencer or celebrity or brand to have conversations with consumers. So let's say, for instance, let's say Rihanna was on it and she had a show coming up in New York City at MSG. I could message with her, say, hey, I'm looking for seats under this price. And it would be like more of a back and forth conversation where then, I could purchase just by saying yes on the platform. But long story short, they were acquired like literally a month and a half or 2 months after we invested in them. So that was sort of the first time where I noticed how quick, things can happen in the venture space. So that was an exciting, it wasn't our biggest exit, but it was one where it just happened so quickly. And we did get a good return on it. So it was a fun one.
Right. And usually when VCs are thinking about exits, they're mostly thinking about 10-year timelines. So what's been the average amount of time that you have seen your exits come through?
We launched our fund in 2016. So, being that it's the end of 2022 now, most of our companies by far are still operating. So obviously we're skewed more towards earlier exits, as there will be later ones that happen further down the line. So, I'd say obviously that one was an outlier, but typically, for our biggest one, it took about 6 years to get to an exit. So it happened more recently, which I think is probably about the minimum amount of time it takes to have a pretty big exit. So we have a few other ones that we're looking to over the next few years that we feel can exit pretty big as well. So I would say it'll probably end up being like a 7 to 8 year average, yep, at least for our first fund.
Right. That's great. And so I have this one last main question for you before we move on to the rapid fire round. So this one is about what is something that you wished that you had learned earlier in your venture journey that you now have learned?
Something I wished I learned earlier. So I guess I'll go a little bit on the side here because we're mostly talking about startups, but a big part of running a fund is we have to fundraise as well. We have to pitch our fund, get limited partners to believe in our vision, believe in us, and to invest in us. So I think I had some sales background before getting into venture as well, and I think back when I was younger and doing the first fund and second fund, I put a lot more pressure on myself to be a good fundraiser, to get people to commit to investing in Green Egg Ventures, in meetings, and which doesn't really make a lot of sense when you're thinking of such a long-term game like venture. It's definitely a relationship, especially at the earliest stages. It's very relationship driven, making genuine connections with people, and building up trust over time is really paramount. So I think once I sort of shifted my mindset to saying, I'm not here to raise money. I'm here to build relationships with people that are interested in venture. And if it's a fit for them and it's a fit for us, all the better. And it just sort of, really takes the sort of pressure off of fundraising and makes it feel a lot more genuine in terms of just wanting to learn about people, share information on what I love, which is, venture and, the founders that we're investing in. So yeah, that really, helped a lot and changed a lot.
Yeah, yeah, and that's a great one. As venture is one of those industries that runs primarily on people. Like it's more of a people business than a money business. So you need to have those relationships in place, and people thinking good of you, so that when there is an opportunity, they remember you over someone else. Right? That's where you win.
That's
Right?
absolutely, yeah, and that's what, like I mentioned earlier, whether it's going to events, it's investors want to work with investors that they like, firstly. So just being out there, meeting people, making connections. I mean, investors want to share deals with people that actually add value to those investments. So, those are really the two things that we look to do, is just be part of the community, add value, and and then just provide support to our companies.
Right, absolutely. That's a great approach. Now, moving on to our rapid fire round. So here I'll ask you 5 quick questions about the fund, and you have to give 5 quick answers. Sounds good.
Okay.
All right. So the first one is, what are the sectors and regions you invest in?
North America and Latin America.
And sectors?
Broad across business to business.
Okay. And what's the typical stage of investment?
10 million or lower valuation, so pre-seed and seed.
Okay. What's the typical check size?
For this fund, 100 to 200K initially, 250K plus in follow-on. Next fund, 300 to 600K initially, 500K to 2 million follow-on.
Great. And where can founders pitch you?
Send me an email at alex@greenegg.vc. It's where we organize all of our deal flow and share a deck, and we'll review it.
Great. And last one is, where can our listeners follow you?
I'm not really on social media so much, but LinkedIn's a good place. Go on LinkedIn, message me, say that you listen to the podcast, and that way I'll know to accept the invite.
Awesome. Thank you so much for coming on, Alex. I love the work that you're doing, and happy investing.
Awesome. Thanks so much, Prashant. Take care.